This is Capital Ideas TV. Coming up, the new CEO of Liquor Stores North America on the company's move into cannabis. Accord Financial CEO completing a 5-year transformation. The CEO of Engagement Labs on why it's a great time to buy the stock. Plus, one of the winners from our stock picking contest. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Recreational cannabis is set to become legal in Canada later this year. When it does, it won't be long before storefronts selling cannabis will be popping up across the country. Some provinces will operate their own retail outlets, while others will leave it to private retailers instead. Alberta and British Columbia are among those, and that means opportunity for Liquor Stores North America. The company owns more than 200 alcohol retail locations in the two provinces, giving it around a 20% market share. In February, Aurora Cannabis purchased 20% of Liquor Stores for roughly $100 million and has the right to buy up to a 40% stake. Now, Liquor Stores is branching out into what's expected to be a very lucrative cannabis retail business. Scotiabank did some analysis on data collected from StatsCan about cannabis consumption. The numbers show Canadians have had an increasing taste for cannabis that will only grow in the coming years. The rate of consumption growth is also expected to pick up the pace in the next few years. Scotia analysts believe that with the right strategy, Liquor Stores can capture 10% of the retail cannabis market. CEO Jamie Burns stepped into the top job at the company in December. He fills us in now on how his plan is shaping up and what the shift into cannabis means for his company's bottom line. Jamie, you took over at Liquor Stores as the CEO in December. Would you say that this Aurora Cannabis deal came together fairly quickly? And also in a general sense, would you say that Liquor Stores moving into cannabis is a natural extension of your business?
We were approached by several licensed producers or investment bankers on their behalf during the late fall with various options and concepts and ideas for partnerships, more or less along the lines of the one we concluded with Aurora. We dealt with several of them as a process for a while before choosing Aurora, relatively hands down at the end of the day as the people we wanted to work with going forward. In terms of us getting to into the cannabis business, yes, it's very definitely have been retailing controlled substances for 25 years, which is obviously unprecedented for a private sector corporation, as most of that activity in Canada is done by government-owned agencies. And we feel we have the expertise and the background to be able to do it responsibly and in a way that introduces this product carefully to consumers in a legal way.
Now let's talk some numbers here, Jamie. Is it possible to make some projections? I'm guessing there's some guesswork involved, but in terms of pricing and sales that you're expecting and margins and market share and those kinds of numbers?
It's really difficult at this stage because we don't know the rules. We don't know the full fiscal regime yet. We're getting closer. We don't know if there's going to be floor price, like social responsibility pricing, where some jurisdictions in America with private retail for liquor for example, have minimum prices for liquor sales set based to keep prices from going too low and encouraging overconsumption. So it's hard to know. We don't really know. And again, we're not focused on what it's going to look like in the first 6 months. We're focused in what this business is going to look like in the long term, what a real business will be once it's fully operational and developed. In terms of market share, Alberta, which is the bulk of where we'll be starting, has mandated that for the first year, they'll only be issuing roughly 250 licenses, maybe more. It's a guideline, not a rule. And no one licensee will be allowed more than 15% of those licenses. So that's 37. So we know that 37 will be the most we'll get in year one, and or anybody else. And until they change that policy, if they decide to do so, the regulator at some point in time will be restricted at 15% of the licenses, which doesn't mean market share, but it means licenses. So we'll probably track pretty closely.
And lastly, Jamie, I mentioned that you were appointed CEO of Liquor Stores in December. You were appointed vice chair before that. You were already on the board. So you know the culture of the company. I'm just wondering, what's your overall strategy? What's your leadership style? And what kind of stamp do you want to put on Liquor Stores?
We're in tremendous shape, and we see it reflected in the culture around the support center, store support center here, head office, if you wish, that there's a spring in everyone's step, and the money isn't being invested right here at home in our province. And slowly over time, we will be regaining our market share that we've lost by ignoring discount competitors and letting them waltz into our markets with impunity. That has ended, and we are aggressively going to, in select cases, make sure that competition knows that they shouldn't have woken the sleeping giant, but they have. And we're very excited about it.
We feel like we're the wave of the future in terms of how people test for things. We anticipate being the first sample-to-answer instrument that can process up to 22 pathogens at a time. Whatever you want to test for, you can do it on your own. You don't have to ship it away to a lab. You don't have to have an expensive microbiologist. It's something you can do on site. You collect that sample, you input it into the machine, you hit a button, an hour later you get the result you're looking for.
Some people believe that you can't teach an old dog new tricks. Well, Accord Financial might have something to say about that. For more than 30 years, the company was devoted to so-called factoring. That's when companies buy account receivables from small businesses at a discount and collect the full amounts owed from their clients. Then Accord started thinking bigger and embarked on a 5-year transformation plan. The company acquired a trio of financing firms, each with its own specialty. Now Accord has plenty of new tricks, including asset-backed loans, inventory financing, equipment financing, small business loans, and media financing. Accord's diversification couldn't have come at a better time. The Canadian and American economies are humming along nicely by most measures, and interest rate hikes are underway on both sides of the border. That's giving small businesses the confidence to invest in the future and fattening the loan books for financiers like Accord. Now here's a look at the PayNet Canadian Small Business Lending Index in orange and its American equivalent in blue. They measure the volume of new commercial loans and leases to small businesses. Both are tracking at robust levels, particularly in the U.S., which has climbed to its highest rate in more than a decade. Accord Financial believes it's poised for a breakout. The company's total portfolio has more than doubled since it kicked off its transformation in 2013. Management is confident that earnings growth will follow, as it has historically for other companies in the financing business. CEO Tom Henderson explains what's in store for 2018. So Tom, at Accord Financial, you're in the latter stages of a transformation that you've been conducting from low growth to high growth, consolidating your units into sort of more of a one complementary overall business, and you've made some key acquisitions, which you'll get into more detail in a while. But I'm just wondering about where that transformation stands and how it's changed the company.
Yeah, so you're right. We're at the end of a 5-year plan that we developed internally with management and support of the board to transform the company from a purely factoring company into a more broad-based asset lending business. We've now seen the fruition of that. Last year we saw the beginnings of a growth in our assets, and earnings follow asset growth in our industry. So we bought, as you said, we bought several companies in the last 3 years. So the internal growth that we created and the acquisition has transformed this company. So if you were an investor and you're looking at a high level at the company, you'd say, okay, that's a slow growth, dividend paying company, but not anymore. So it's now a much faster growing company. We intend to still pay a dividend, I'm sure, but it won't be at the same percentage of the earnings as we have in the past. because we expect the earnings to really respond to this growth that we planned for 5 years now.
Now, if you say to somebody commercial lending, just in a general sense, they think, well, that's not very sexy. But you recently got into a pretty sexy business, and that's film and television with the Bonded Capital, this acquisition that you made. So that's sort of a notoriously lumpy business, lots of hits, lots of misses. So what kind of due diligence did you do to confirm for yourselves that this was a good way to go to get into Hollywood, basically?
I was surprised that I was interested in it when an investment banker called me about 1.5 years ago. And they were looking for financing. And I said, this is a very interesting business. I've never had the experience of seeing detail like this. I said, is the company for sale? He said, well, funny you asked. They'll be looking for an investment. And it's run by 3 marvelous guys that are 30 years old who come out of the movie production industry, but they're so financially sophisticated, it just blew me away. So when I met them finally in Santa Monica and asked them about their business, I was looking at the risk aspects of their business. It didn't seem risky at all because they have a strategy that they underwrite each production, and they have their own production company if they need to step in to remedy a situation that might go off the rails. These are unbelievable guys. We're so happy we are now associated with them.
And the Bonded Capital contributed to your recent earnings, which came out a while ago. And in the quarter, you had record amount of funds deployed. You had record revenue. So give us a sense of the numbers and what we can look for in the rest of the year, 2018.
So with respect to the acquisitions, there were 2 acquisitions last year. You mentioned one, the Bonded Media Company. That was in July. And in October, we did a much more energetic thing by buying CapEx Partners in Chicago. This is a well-established 18 years in business, commercial leasing and equipment financing business. We took that business just the management. We didn't buy their assets. They had a fund they were supporting. We took the assets, the people of that business, and started from scratch last October. So with lots of expenses, 0 assets, and now that's ramping up very noticeably this year. So, and that was part of the asset growth last year, but most of the asset growth last year came from the internal growth of the existing asset-based lending business that we've been growing the last 5 years. So going forward, we see a nice steady spike in asset growth, which is usually followed a few quarters later by the actual earnings that investors would see.
Now, Accord Financial has paid a dividend. It peaked around 2015, and I know that one of our contributors, Fabrice Taylor, was on BNN, I want to say 2013, recommending your stock. It did really well. Lately, it's been in a long consolidation mode. So how do you get the word out that you've made this transformation and that people should be looking at Accord Financial?
Well, we really haven't been good at explaining to the market what we've done internally. We have chosen to take the tack of let's see the numbers speak for themselves, and they are about to do that. But we're also very interested in the help of anyone who can assist us in getting the message out.
You also look at the stock, and average volume, I think, is under 1,000 shares. So if I'm a retail investor, I'm thinking, well, why would I want to invest in that? I like the company, but I want to see it more liquid. So how do you make that happen? Because you said off air that insider ownership is something like 80%, with a lot of that with the founding families.
Yes. It's difficult. Believe me, I know it's difficult to buy the shares. You have to be patient. And if you own the shares, you may not find them so liquid. So that's a situation, Mark, that we've faced since we went public in 1992. Nothing really has changed. We're accustomed to that, but we intend to change that to make our shares more interesting to the general investing public. So over time, we expect to see that share of ownership that is closely held reduce.
Blockchain is going to be big. It's early days right now. It's much like the internet in the 90s, and we want to be in early. And we're diversifying our investments so we can sort of pick those winners and in 10 years from now, see the benefits from today's investments. We were one of the first public companies to dedicate ourselves exclusively to blockchain. We know that in 5 to 10 years from now, it is going to define consumer life, finance, real estate, healthcare, and we offer a good exposure into this early technology for our investors.
If there's one force that marketers of all stripes need to contend with, it's the power of herd mentality. A brand's success or failure rests largely on how consumers feel about it, and those same consumers are deeply influenced by what those around them have to say. Nowhere is that more obvious than on social media networks, as a recent study by PwC discovered. Researchers found that social networks are the most powerful online tool in determining what a shopper wants to buy. Networks like Facebook, Twitter, and Instagram were referenced by 37% of the 22,000 respondents surveyed. The study also found that trust in a brand was the second most influential factor in a purchasing decision after price. Most brands are aware of how large a role social media can play in creating or destroying that trust. But what they often overlook is how equally persuasive offline conversations can be. Engagement Labs is the go-to authority on that subject. The company has cultivated 12 years worth of data on word-of-mouth conversations and their influence on consumers. What they found would surprise most marketers. Engagement Labs discovered offline conversations are just as predictive of buying behavior as online conversations. That held true across virtually every retail category, be it technology, food, or beauty supplies. Taken together, online and offline conversations account for roughly 20% of a brand's total sales. That adds up to anywhere between $7 and $10 trillion of annual spending. With such a massive slice of buying behavior in the balance, marketers need to understand how consumers are feeling at any given time. Engagement Labs has designed just the tool for the job. Its new and improved TotalSocial 3.0 platform uses artificial intelligence and machine learning to pull insights from both online and offline conversations. It then recommends ways that brands can adjust their marketing strategy to influence that ever-changing sentiment and capitalize on it. Engagement Labs CEO Ed Keller explains what TotalSocial brings to the table and how it will help drive the company's growth. Ed, since we last talked, you've made a lot of advancements to TotalSocial. You've got TotalSocial 3.0. So give us a sense of some of the AI and machine learning that you've bolted on to enhance TotalSocial.
So earlier this year, we launched our 3.0, where we brought machine learning into our predictive analytics, allowing us to very quickly run through a lot of different ways that clients can get the maximum benefit and understand exactly which types of social media and word of mouth are going to drive performance for them. And then just recently, we've now brought artificial intelligence into our diagnostics as well, where literally the machine tells us in real time when there's something that's happening that's unexpected, and us and the client, we can begin to look to see exactly what's happening and how can they take advantage of a trend in real time or deal with a problem in real time. So the power of artificial intelligence in what we do is very significant, and clients are responding very well to it.
You put a release out recently which said that you had about $7 million in revenue from TotalSocial in 18 months' time. What's the significance of that for Engagement Labs?
Yeah, so TotalSocial is a new and quite an innovative product. We're the only people who are taking and integrating online word of mouth with offline word of mouth. We have predictive analytics that power it to help our clients understand exactly what the future impact of changes in total social metrics are. And so when you introduce something that's new and different to the marketplace, you're looking for validation. We knew we had a good idea, but how quickly would clients adapt it? And the fact that we're over $7 million in revenue in just a year and a half to us is excellent validation that the marketplace understands what we do, understands how it's different, understands how it's better, and we're getting blue chip clients across a whole range of verticals. So to us, it indicates that we're on the right path and that the marketplace agrees with that.
Let's talk more about that. Many of your clients and customers are Fortune 500 companies. They prefer they not be named, but you're talking about some big names in beauty, financial services, a major sports league. So what kind of traction are you getting with clients and customers, and what kind of feedback are you getting?
Yeah, so we're really happy that we've gotten adoption from across a whole range of verticals. Sometimes you launch something new and you think that companies maybe that are in technology with hot new sexy products, maybe they're the ones who can take advantage of social trends. But we've discovered that we've got a range of of verticals, and to us that indicates we've just brought in some retail clients lately, and now we're going after a bunch more retail clients. So every time we get a marquee brand in a single sector, it helps us to understand, okay, time to go after other brands in that same vertical. And the fact that we've got a range of verticals now, we're covering about 15 within TotalSocial, and we know that the impact of TotalSocial improvement is considerable, not just for high ticket items, but for everyday products as well. And it helps us to realize that there's a large market that we can go after and be successful with.
Ed, as far as marketing for the company and awareness for Engagement Labs, you have an over-the-counter listing in the U.S. now. So how important is that in terms of attracting a whole new investor base?
Yeah, so we've been on the TSX Venture Exchange for several years now with Engagement Labs, but we made a decision about a year and a half ago to focus more of our energy with TotalSocial around the U.S. market, and we think that there's a great opportunity to introduce new investors to our stock and take advantage of our growing U.S. presence. And so in March of this year, we secured a listing on the OTC, and we're beginning now to actively make sure that that investor group knows who we are and what we do, and we think it will expand significantly the number of investors who can become part of Engagement Labs, increase our volume of shares, and ultimately be beneficial to all of our shareholders in the U.S. and in Canada.
In your most recent report, one of the impressive numbers was gross margins rising 48%. At what point do you think we can see a cash flow positive for Engagement Labs?
Yeah, so we put out recently our preliminary Q1 results, and there's a couple of things that I thought were notable, and one was the rise in gross margins, which I think reflects our growth and the fact that we'd taken a lot of cost out of the business about a year and a half ago, and it's really helping our margins. We also saw that year-over-year revenue had gone up 25%, which indicates to us that we're on the right track. As you may know, we hired a chief revenue officer in late December of last year, and we're making a big investment in sales, and we've got a platform, we've got a database, and the more we sell, the marginal profitability is very high on every new client. So we think we'll ultimately continue to grow at a rapid rate, and we're beginning to really hit our stride now, and we think our gross margins will be able to continue to rise, and I think from a cash flow positive point of view, we're getting closer. I don't know yet whether it's going to be early 19, something like that, but we're definitely on a path toward getting there.
Now, you've talked about validation from Fortune 500 customers. You had that great run from 4 or 5 cents to 25 cents or so, and then the stock sort of returned to where it was. There was a lot of volume for a while, and then volume dissipated to a degree. So what can you tell us about the stock, and what can you tell investors about what kind of opportunity there is here?
Yeah, so we had put out a series of releases about new clients we had signed, about some renewals, and I think the marketplace got excited and the stock went up as a result. We had just done a financing that had a 4-month hold period, and so as we got to the end of that 4-month hold period, I think some of the investors were taking advantage of appreciation and started to sell, and so the stock went back down. I think we have no short-term selling pressure at this stage. I think we're going to have a series of continued announcements to make, and I think our stock is low relative to where it should be. If we look at our market capitalization, it's about 2 times revenue. I think comparables in our space tend to sell for 6 to 8 to 10 times revenue. So I think as we continue to deliver and have good news, I think now is a great time, honestly, to be getting involved in our stock. I think we should have a very good run of appreciation ahead of us.
We're proud of the fact that we've been profitable every year since inception. If you have a business and you have a vision for it, and you want to borrow some serious money, you have to know who your lender is. You have to trust them. What we're doing is providing the capital that enables them to realize their ambitions. Money means everything to people who don't have it. We're here, we're stable. We got 40 years now, we're looking at the next 40. You can take these guys to the bank.
You may remember we had a $25,000 winner-take-all stock picking contest. We had 2 winners, Jason Stanley of Delta, BC, who's an entrepreneur. He runs 3 businesses, and Warren West, a retiree in Winnipeg. They both chose Cronos Group, which soared more than 540% in 2017. Right now, we're going to speak to Warren West on the hows and whys of his victory. Warren, cast your mind back to late 2016 when you were deciding on which stock or stocks to choose for our stock picking contest. What were some of the factors that compelled you to buy, or at least to pick Cronos Group?
Well, what I do is I started reading their news releases, and at that time they were trading as Pharmacan Capital, and it seemed like a pretty interesting stock. And as they released their financials for September, they came out at the end of November, and I kind of made my mind up for the Capital Ideas contest that I wouldn't enter it until the last minute. So what happened was the financials were quite good. They had good cash, they had revenue, and I thought their story was quite good going forward. So as far as making that pick, at the end of December, I think it was December 28th, they had a news release where they said that they were entering into a partnership with a European company, German, I think, for distribution of cannabis products in Europe. And that kind of sealed it for me. I thought, this looks like people who got their story together, and they seem to have good financials, seem to have a limited downside risk. So I decided to pick that as one of my picks.
That's great. So you did your research. Now fast forward, on the second last trading day of the year, Cronos Group became the leading stock in the contest, which was really quite remarkable. What were your thoughts and feelings then?
Well, I thought, at that point, I couldn't really tell that it was in the lead because I didn't have all the information. I didn't have who else was in the contest. I didn't know if there were some stocks that perhaps weren't in that top 10 that maybe were off the board that came up as well later on. So for me, it was a mystery until about, I guess, a week later when you folks verified the results and said that, Cronos had, in fact, won. And I guess I had shared the prize with Jason at that point. That was pretty exciting. That was, it's still exciting when I think back on it, the move it made, and I wonder, how did it make such a move in such a short period of time? It basically tripled in 3 months. So,
yeah, exciting stuff. $12,500, and good for you.
Okay, well, thanks very much, and thanks for holding the contest.
There you have it. That's Warren West of Winnipeg, one of our winners in our stock picking contest. Now let's hear from the CEO of Cronos Group, Michael Gorenstein. Here were his thoughts on his company being the top performer in our contest.
That's great. It's like that's one of the most gratifying things about being a public company is that you're sharing your success with others, and it's tangible. When we started off, I actually was an investor in cannabis, and part of the reason we took over an active management role is we were not necessarily pleased with the way that a lot of the management teams were treating shareholders, whether it was toxic financing vehicles, self-dealing, over-promoting. And so what we did was a little different, where we invested our own capital. We weren't founders. We took over, and we operated the way that we thought the company should be operated and the way we wanted to be treated. And we haven't been loud. So when people are catching on, it means a lot to us, and that's it's huge.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. Now be sure to subscribe to our YouTube channel so you don't miss an episode. For more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. We now have a podcast, Capital Ideas Radio, and you can listen and subscribe at iTunes, Stitcher, Google Play, and TuneIn. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.